Welcome to XRP Pro Ledger, and today we are sitting in one of those sessions where the price chart looks like absolutely nothing is happening, and that is precisely why you need to be paying the closest attention you have paid in months. XRP is grinding between $1.42 and $1.44 right now, barely moving on the one-day chart, barely moving on the one-week chart, and the fear and greed index is pulled back to 44 neutral territory because the majority of the market is sitting on the sidelines waiting for breakout confirmation before they commit capital. But while everyone is waiting for the signal, three things just happened that you need to understand right now. XRP added $900 million in tokenized real-world assets in a single day, pushing the total XRPL real-world asset value to an all-time high of $3.50 billion. 7 billion XRP has left exchanges this year in what analysts are calling coordinated, deliberate supply compression happening at the exact moment Ripple is gaining access to treasury decision-makers at 5 of the world's largest banks. And XRP wallet creation is surging with 86,000 new wallets per month in 2026, even while the price is compressed. The calm before the storm is not a metaphor right now. It is a measurable, documented, on-chain reality. Let us start with what is actually happening in the geopolitical environment today, because it is affecting market sentiment and keeping investors on the sidelines in a way that deserves a clear-eyed analysis rather than emotional reaction. President Trump is sending Steve Witkoff and Jared Kushner to Pakistan for a second round of Iran talks. Oil prices dropped to a new daily low on the news. Then Iran's supreme leader announced that negotiations with the United States are forbidden under current conditions. Then a separate report emerged saying Iran plans to make an offer aimed at satisfying U.S. demands. Three contradictory headlines in the same trading session. Oil swung from $83 back above $90 and then reversed again as each headline landed. The crypto market is not reacting to the Iran situation the way it was a few months ago. That geopolitics decoupling is a genuine regime change in market behavior that we have been tracking on this channel. But the uncertainty is still keeping conservative investors on the sidelines, which is exactly why the ETF tracker is showing $8.16 million in volume on a day with minimal price movement. The institutions are still buying, the retail investors are still waiting, and the gap between those two behaviors is the setup for what comes next. The $900 million in tokenized real-world assets added to the XRP ledger in a single day is the kind of data point that should be stopping people in their tracks, and instead, it is being treated like a routine update because the retail market is too focused on the daily price candle to look at the infrastructure metrics that actually drive long-term value. Let me put that number in context. The entire XRPL real-world asset total just hit an all-time high of $3.50 billion, and $900 million of that, more than a quarter of the entire cumulative total, was added in a single 24-hour period. This is not a gradual build, this is an acceleration. And the people who are saying XRP Ledger is only going to capture a small percentage of the global tokenization market need to explain why a network that just added $900 million in a single day at what is essentially the very beginning of the tokenization era is going to stay at a small percentage when the DTCC, the Nasdaq, and every major financial institution on earth starts ramping up their tokenization activity in the second half of 2026. The math does not support the pessimism, and the on-chain data is proving it in real time. The 7 billion XRP that has left exchanges this year is the supply compression story that connects directly to the Shane Ellis institutional liquidity thesis, and it deserves a serious analytical treatment rather than a passing mention. 7 billion XRP removed from exchanges is not retail investors moving their bags to hardware wallets for security. That scale of coordinated supply removal happening at the exact moment Ripple is gaining direct access to treasury decision makers at 5 of the world's largest banks is the fingerprint of institutional positioning. Large, sophisticated entities removing XRP from the liquid trading supply because they expect the price at which they can acquire it to be significantly higher in the near future. Coinbase specifically slashed their XRP reserves by 200 million since the start of 2026. The same pattern is appearing across multiple major exchanges simultaneously. When supply compresses on multiple platforms at the same time during a period of institutional access expansion, you are not watching organic retail behavior. You are watching coordinated, deliberate pre-positioning ahead of a demand event that the entities doing the positioning already have visibility into. The analyst calling for XRP to reach $6 by June is a projection that deserves engagement rather than dismissal. because the pathway to that target is not dependent on a single catalyst, but on the convergence of multiple developments that are already in progress. The bottom at $1.30 appears to be structurally confirmed by the technical data. XRP has bounced off that level multiple times, and the pattern of higher lows is visible even during the current compression phase. A solid May that brings a sustained break above $1.50 sets up price discovery in June that could genuinely reach new all-time highs. Most serious chart analysts are still projecting a summer run for XRP, and the fundamental backdrop that supports that projection, DTC tokenization production ramping up, Clarity Act markup approaching, institutional ETF demand building daily is stronger today than it was when those projections were initially made. The $6 June target requires the breakout to begin soon, but nothing in the current technical or fundamental picture suggests that timeline is unreasonable. What it requires is patience through the compression phase that we are sitting in right now. The new wallet surge is the retail demand signal that often gets overlooked in favor of price action, but that consistently precedes the most significant bull market moves in XRP's history. XRP has averaged 86,000 new wallets per month in 2026. Total XRP wallets have increased by 343,000 this year so far, and the pattern of wallet creation is doing what it historically does before a parabolic move. New wallets are being created during the price compression phase, not during the price spike phase. When the price was at its highest points in previous cycles, wallet creation slowed because the people who were going to buy already bought, and the people who were late were buying at the top. New wallet creation during a compression phase means new participants are entering the market at discounted prices in anticipation of a move that has not happened yet. These are not people buying on excitement, they are people who have done enough research to conclude that the current price is an opportunity rather than a danger, and they are building positions before the social proof mechanism triggers the mass retail FOMO event. The 4-year cycle analysis that many participants are still using to frame their XRP expectations is the framework that needs to be retired most urgently, because it is producing projections like XRP not reaching a new all-time high until 2028 that ignore the fundamental structural change that is happening in the digital asset market right now. The 4-year cycle was a pattern driven by Bitcoin halving mechanics and retail sentiment cycles in a market dominated by speculative activity with minimal institutional infrastructure. That market no longer exists. The market that exists today has Goldman Sachs holding $153 million in XRP ETFs, the DTCC preparing tokenization production, Ripple gaining access to the treasury decision makers of the world's largest banks, and FedNow integration documented as live. None of those developments were part of any previous 4-year cycle. The transition from a speculative cycle market to a utility-driven market is the regime change that makes the 4-year cycle framework obsolete, and XRP, built for exactly the utility-driven environment that is now arriving, is positioned to benefit from that regime change in ways that the 4-year cycle timeline simply cannot capture. The compression pattern that Dark Defender and other serious technical analysts are highlighting right now is one of the most historically reliable setups in XRP's chart history, and understanding it correctly changes how you should be thinking about the current flat price action. XRP holding $1.30 as the confirmed base, bouncing off that level multiple times, compressing in an increasingly tight range between $1.42 and $1.44. This is the technical structure that precedes violent directional moves, not gradual continued sideways trading. The compression is the market storing energy. Every day that passes without a breakdown below $1.30 is another day of energy storage. Every day that the institutions are buying through the ETF channel while retail waits on the sidelines is another day of accumulation building beneath the compression. When the compression resolves, and it will resolve, because price compressions always do, the move that comes out of it is proportional to how long the compression lasted and how much institutional accumulation built up inside it. We have been in this compression long enough that the resolution, when it comes, is going to be significant. The double-digit XRP conversation is the one that makes the most cautious long-term analysts uncomfortable, but that becomes unavoidable when you look at the tokenization numbers honestly. When XRP hits $10 and the on-chain data, the institutional positioning, and the tokenization trajectory all point toward $10 being a question of when, rather than whether, the narrative that has suppressed retail enthusiasm for years breaks completely. The argument that XRP cannot go above $10 because of market cap concerns and historical cycle patterns has been the primary ceiling on retail expectations for this asset. The moment XRP crosses $10 and holds, that ceiling collapses. And what happens when a narrative ceiling that has been suppressing retail expectations for years suddenly disappears is not a gradual adjustment, it is a psychological reset that generates the kind of euphoria-driven retail demand that makes previous cycles look conservative. The $900 million single-day RWA addition, the 7 billion XRP removed from exchanges, the 86,000 new wallets per month, or in the Coinbase supply compression are all building toward exactly that reset. The complete picture today is one that rewards patience and punishes impatience in the most direct way possible, because every day that the retail market sits on the sidelines waiting for breakout confirmation is another day that the institutional accumulation deepens, the exchange supply compresses further, and the gap between what XRP is worth based on its deployed infrastructure and what it currently trades at grows wider. The calm before the storm is measurable. 7 billion XRP off exchanges, $900 million in tokenized assets added in a single day, $3.50 billion in total XRPL real-world assets at an all-time high, 343,000 new wallets created this year at compressed prices, $8.16 million in ETF volume on a flat price day. The frustration that most XRP holders are feeling right now is not a sign that the thesis is broken, it is a sign that we are at exactly the point in every previous cycle where the people who stayed patient went on to build life-changing wealth while the people who gave up walked away from the most significant financial opportunity of their generation. Stay patient, stay positioned, the compression is almost done. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.